September 2008. Lehman Brothers, one of the most powerful investment banks in the world, files for bankruptcy. Founded in 1850, it survived civil wars, world wars, depressions, and financial panics, but it could not survive the modern financial system. Within hours, global markets begin to panic. Stock prices collapse. Banks stop lending, not just to customers, but to each other. Money market funds, once considered safer than banks, start breaking apart. Behind closed doors, governments prepare emergency plans for a complete financial shutdown. This is not a market correction. This is not a normal recession. This is a systemic failure, the worst financial crisis since the Great Depression. By the time the dust settles, nearly $19 trillion in household wealth disappears. More than 8 million jobs are lost in the United States. Millions of families lose their homes. Entire economies enter recession. And the damage does not stay in America. Europe collapses into a sovereign debt crisis. Global trade freezes. Emerging markets are hit overnight. Yet this crisis did not begin in 2008. It was built slowly, over years, inside a system that rewarded risk, ignored consequences, and convinced itself that modern finance had eliminated failure. This documentary is the full story of how it happened. From cheap money and reckless lending, to Wall Street's financial engineering, to the moment the global economy stood on the edge of collapse, and why the effects of 2008 still define your economy today. The economic climate after 2000. To understand the 2008 financial crisis, we need to go back to the early 2000s. In 2000, the dot-com bubble bursts. Technology, stocks collapse. Billions of dollars in market value vanish. 1 year later, the September 11th attacks shake confidence in the global economy. The United States faces the threat of a prolonged recession. The Federal Reserve responds aggressively. Interest rates are cut to historic lows. Borrowing becomes cheap. Liquidity floods the system. The logic is simple. Cheap credit encourages spending, investment, and growth. But cheap money always has consequences. Housing becomes the engine of growth. With borrowing costs low, housing becomes the centerpiece of economic recovery. Homeownership is promoted as a social good. Politicians support it. Banks profit from it. Housing prices begin to rise, slowly at first, then faster, then exponentially. As prices rise year after year, a powerful belief takes hold. Housing prices do not fall nationwide. This assumption becomes the foundation of the entire system. The breakdown of lending standards. Traditional mortgage lending is cautious by design. Borrowers must prove stable income, strong credit history, ability to repay. But in the early 2000s, this discipline erodes. Lenders discover they no longer need to worry about repayment. Why? Because they are no longer planning to keep the loans. They are planning to sell them. This shift changes everything. Subprime mortgages, loans issued to high-risk borrowers, explode. Some loans require no income verification, no down payment, adjustable rates that reset sharply higher. The goal is not long-term stability. The goal is volume. More loans mean more fees. Risk is someone else's problem. From mortgages to securities. Once mortgages are issued, Wall Street takes over. Thousands of home loans are bundled together and converted into mortgage-backed securities, MBS. These securities are sold to pension funds, insurance companies, hedge funds, banks around the world. The pitch is irresistible. Higher returns, diversified risk, professional ratings. But the reality is far darker. The illusion of safety. Rating agencies play a critical role. They label large portions of these securities as AAA rated, the highest possible safety grade. Investors trust these ratings. They assume risk has been scientifically measured and minimized. But the models are deeply flawed. They rely on one dangerous assumption. Housing prices will continue rising. If that assumption fails, the entire structure collapses. CDOs, risk disguised as innovation. Wall Street doesn't stop at mortgage-backed securities. They go further. Risky tranches of MBS are repackaged into collateralized debt obligations, CDOs. This is financial engineering at its most dangerous. Bad loans are mixed together and sold as safe investments. Even professionals struggle to understand what they are buying. Complexity hides risk. Leverage, the silent multiplier. Investment banks borrow heavily to amplify returns. Some institutions operate with leverage ratios exceeding 30-1. This means small gains create massive profits. Small losses wipe out capital. The system becomes extremely fragile. But profits are enormous. Bonuses soar. Warnings are ignored. By 2006, the American housing boom began to slow. For the first time in years, home prices stopped rising. This alone should not have caused a global crisis. But the entire financial system was built on the assumption that housing prices only move upward. That assumption was wrong, and once it broke, everything built on top of it began to crack. Millions of mortgages issued during the boom were adjustable-rate loans. Borrowers were attracted by low introductory payments that made homes seem affordable. These loans were often approved with minimal income checks and little regard for long-term ability to repay. When the teaser rates expired, monthly payments jumped sharply. For many households, the increase was impossible to absorb. Borrowers had expected to refinance or sell before the reset. But with prices no longer climbing, those exits vanished. Defaults began to rise. At first, the damage appeared limited. Missed payments were scattered, concentrated in subprime neighborhoods. But foreclosures have consequences beyond individual borrowers. As homes were repossessed and resold at lower prices, surrounding property values declined. Falling prices pushed more homeowners into negative equity, owing more on their mortgage than their house was worth. Once underwater, many borrowers stopped paying altogether. This created a feedback loop. Falling prices caused defaults, and defaults pushed prices even lower. As housing weakened, Wall Street felt the impact. Mortgage-backed securities began to lose value. Banks attempted to assess their exposure, but many of these assets were complex and rarely traded. Without active markets, prices were based on internal models. Those models relied on assumptions, low default rates, and stable home prices that were no longer true. Balance sheets became uncertain. Institutions could not clearly determine how much they were worth or how much risk they carried. Uncertainty spread quickly. Banks rely on short-term borrowing to operate. They lend long-term but fund themselves overnight. This system only works when trust is absolute. As doubts grew, banks became reluctant to lend, even to each other. Interbank lending slowed. Credit tightened. Liquidity began to dry up. The financial system was not collapsing yet, but it was seizing up. Throughout 2007, officials publicly downplayed the risk. The problem, they said, was contained. The broader economy remained strong. But behind the scenes, failures were mounting. Subprime lenders collapsed. Hedge funds exposed to mortgage securities shut down. Major banks froze investment funds because they could not value the assets inside them. These were warning signs that the crisis had moved far beyond housing. In March 2008, the situation escalated dramatically. Bear Stearns, one of Wall Street's largest investment banks, faced a sudden loss of confidence. Clients pulled funds. Counterparties demanded more collateral. Within days, the firm ran out of liquidity. Fearing a chain reaction, the Federal Reserve stepped in. Bear Stearns was sold in an emergency rescue at a fraction of its former value. The collapse was stopped, but the system was now on life support. By the summer of 2008, the financial system was fragile. Major institutions were heavily leveraged and deeply interconnected. Trust existed only because markets believed the government would intervene if things went wrong. But this belief created a dangerous calm. The housing collapse had already happened. The financial damage was already embedded. The only question left was where the next failure would strike, and whether the system could survive it. By mid-2008, the global financial system was already fragile. Banks were holding assets they didn't understand. Balance sheets were full of securities no one wanted to buy. Trust, the invisible glue of finance, was evaporating. But the real breaking point came in September 2008. The slow death of Lehman Brothers. Lehman Brothers wasn't a small player. Founded in 1850, it was deeply embedded in mortgage securities, commercial real estate, complex derivatives. As housing prices collapsed, Lehman's losses piled up. Investors lost confidence. Its stock price fell sharply. Creditors demanded more collateral. Behind the scenes, the U.S. government searched for a buyer. Talks were held with major banks. Negotiations dragged on through the weekend of September 13th to 14th. But no one wanted Lehman's toxic assets. And this time, the government made a decision that changed everything. They refused to step in. September 15th, 2008. On Monday, September 15th, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history. Markets reacted instantly. Stock indexes plunged. Credit markets froze. Banks stopped lending, not just to customers, but to each other. This wasn't panic. This was paralysis. Why Lehman's failure was different. Financial systems run on confidence. Lehman's collapse sent a brutal message. No institution was guaranteed survival. If Lehman could fail, anyone could. Money market funds, long considered ultra-safe, came under pressure. One major fund broke the buck, triggering investor runs. Corporations struggled to access short-term funding to pay workers and suppliers. Within days, global trade began to slow. The modern financial system, built on short-term trust, was breaking in real time. The AIG bomb. Just days after Lehman's collapse, another disaster loomed. AIG, one of the world's largest insurance companies, was drowning. Through a division called AIG Financial Products, the company had sold massive amounts of credit default swaps. These were essentially insurance contracts on mortgage securities. When those securities collapsed, AIG faced enormous collateral calls. If AIG failed, banks around the world would take catastrophic losses. This time, the government stepped in. AIG received an emergency $85 billion bailout, eventually growing much larger. The lesson was clear. Lehman was allowed to fail, but the system could not survive many more failures. TARP and the bailout era. With markets collapsing, U.S. officials rushed to act. Congress passed the Troubled Asset Relief Program, TARP, a $700 billion rescue plan. The goal was simple: stabilize banks, restore confidence, prevent total collapse. Governments around the world followed similar paths. Central banks injected trillions into the system. Interest rates were slashed to near zero. Liquidity became unlimited. This was not normal economic policy. This was emergency medicine. Public anger explodes. While banks were rescued, ordinary people were not. Millions lost homes through foreclosure. Unemployment surged. Savings were destroyed. Executives at rescued institutions continued earning bonuses. The phrase "too big to fail" entered public consciousness. Trust in institutions collapsed. The crisis wasn't just economic anymore. It became political and social. The global shockwaves. When the U.S. financial system began to collapse, the shock did not stay within American borders. The crisis spread outward, faster and more violently than policymakers expected. For years, U.S. mortgage-backed securities have been sold across the world as safe, high-quality investments. European banks, Asian funds, and global pension systems all held them. When those assets lost value, the losses were instantly global. Banks in Europe were among the first to feel the pressure. Many had borrowed heavily in U.S. dollar markets to fund long-term investments. As confidence collapsed, access to dollar funding dried up. Even solvent institutions faced liquidity crises. Governments were forced to intervene. In the United Kingdom, major banks required emergency support. Across Europe, states rushed to guarantee bank deposits to prevent mass withdrawals. The crisis was no longer American. It was systemic. Emerging markets were hit next. Capital fled risky assets. Currencies weakened. Stock markets plunged. Countries that depended on foreign investment suddenly found themselves exposed. Trade slowed sharply as credit dried up. Global commerce depends on financing, letters of credit, insurance, and short-term loans. When banks stopped lending, ships stopped moving, Factories slowed production, and layoffs followed. International institutions warned that the world economy was entering its most dangerous phase since the 1930s. Governments coordinated emergency measures, cutting interest rates and injecting liquidity. But trust, once lost, is slow to return. The global financial system had been tightly interconnected. That interconnectedness, once seen as strength, now amplified the damage. The crisis revealed how deeply the world depended on a small number of financial centers, and how fragile that dependence truly was. The human cost. Behind the charts, bailouts, and balance sheets was a human disaster. As credit froze and businesses struggled, layoffs surged. In the United States alone, more than 8 million jobs were lost. Entire industries shrank. Construction collapsed. Manufacturing declined. Small businesses failed not because they were unprofitable, but because they could no longer access credit. Foreclosures spread through cities and suburbs alike. Families lost homes they had lived in for years. Savings were wiped out. Retirement accounts collapsed as stock markets plunged. For many, the American dream did not slowly fade. It ended abruptly. The psychological impact was severe. Anxiety, depression, and long-term financial insecurity followed millions of households. The crisis also reshaped inequality. Those at the top of the financial system were rescued. Major banks survived with government support. Meanwhile, ordinary workers bore the cost through unemployment, wage stagnation, and lost wealth. Trust in institutions eroded. Public anger grew. Protests emerged across countries, fueled by the belief that the system protected banks but not people. Young workers entering the job market during the crisis faced lasting damage. Lower starting wages reduced lifetime earnings. Homeownership rates fell. Economic mobility slowed. The effects of the crisis did not end when markets recovered. They persisted for years, shaping a generation's relationship with money, risk, and opportunity. The lessons and the legacy. In the aftermath of the crisis, governments promised reform. New regulations were introduced to reduce risk and increase oversight. Banks were required to hold more capital. Risky lending practices were restricted. Stress tests were designed to measure resilience under extreme conditions. On paper, the system became safer. But the deeper lesson of 2008 was not about regulations alone. It was about incentives. The crisis revealed what happens when short-term profits are rewarded while long-term risks are ignored. It showed how complexity can hide danger, how models can replace judgment, and how belief in perpetual growth can blind even experienced professionals. The financial system recovered, but it did not fundamentally change its nature. New risks emerged. Debt levels increased. Asset prices rose again, supported by low interest rates. The memory of 2008 faded, even as its structure remained embedded in modern finance. The legacy of the crisis is not just economic, it is psychological. It reshaped how people view banks, governments, and markets. It reminded the world that financial systems are human systems, driven by fear, greed, and belief. And it left one unresolved question. When the next crisis comes, will the world recognize the warning signs or repeat the same mistakes once again? Why 2008 still matters. Almost equals 800 words. The 2008 financial crisis was not an accident. It was the predictable outcome of a system that rewarded short-term profit and ignored long-term risk. It nearly destroyed the global economy. And while the headlines faded, the consequences never did. Housing affordability, rising debt, asset bubbles, public distrust, all trace their roots back to 2008. Understanding this crisis isn't about the past. It's about recognizing patterns. Because the next crisis won't look the same, but it will come from the same place. Unchecked leverage, blind trust, and the belief that this time is different. If this breakdown helped you understand how financial crises really happen, not just what went wrong, but why it keeps happening, support the channel. Like the video, subscribe, and stay with us for stories that shape the world you live in.